If you have a traditional IRA or a 401k, the way you take money out could quietly cost you thousands of dollars, and most people never see it coming. There's a required withdrawal rule that starts at a certain age, and missing it triggers a penalty on top of your regular taxes. But that penalty isn't even the most expensive mistake. There's a timing trap that can raise your taxes and even your Medicare premiums 2 years later. Stay with me, because by the end, you'll know exactly what to check, what to avoid, and how to keep more of your own money. This matters most if you're approaching your early 70s, or if you're already there and taking money from a traditional IRA, a 401k, or a similar pre-tax retirement account. It also matters if you're helping an aging parent manage their accounts. Dot here, quote, is the first thing you need to understand, and it applies to almost everyone with a traditional retirement account. Dot, once you reach a certain age, the government requires you to start taking money out of your pre-tax retirement accounts. These mandatory withdrawals are called required minimum distributions, often shortened to RMDs. In plain terms, it means the IRS says, you've delayed taxes on this money for years, now you must start withdrawing some of it so it can finally be taxed. Under current law, the age when this begins is 73 for most people retiring today. So if you turn 73 this year, the clock has started. Dot. This applies to traditional IRAs, most 401k and 403b accounts, and similar pre-tax plans. It does not apply to Roth IRAs while the original owner is alive, and that difference matters, so hold that thought. Dot here, quote, is how it works. Each year, you must withdraw a minimum amount based on your account balance at the end of the prior year and your age. Your account provider can usually calculate this for you, and many will tell you the exact figure if you ask. Let me give you a realistic example. Imagine someone with a traditional IRA who turns 73. The IRS expects a minimum withdrawal that year. If that person simply forgets or assumes they can leave the money untouched because they don't need it, they've now missed a required distribution. And that's where the trouble begins. If you miss all or part of your RMD, the amount you fail to take can be hit with an extra tax penalty. Recent law reduced that penalty from what used to be a steep 50% down to 25%, and it can drop to 10% if you correct the mistake within a specific window and follow the right steps. That's better than it used to be, but it's still money leaving your pocket for no reason. So what should you do? First, find out whether you've reached the age where withdrawals are required. Next, ask your account provider for your required amount for the year. Then make sure it's withdrawn before the yearly deadline, which for most people is the end of the calendar year. Now, one important point people misunderstand. Taking your required withdrawal is not optional generosity to the government. It's a rule with teeth. But the required amount is a minimum, not a maximum. You're allowed to take more if you need it. The mistake is taking less than required or nothing at all. And here's why the next point matters even more. Even people who take their withdrawals on time can still lose thousands because of when they take them. That timing trap is where the real damage happens. This is the mistake that catches careful, responsible people, the ones who thought they did everything right. When you reach the age for required withdrawals, the law gives you a little extra breathing room on your very first one. Your first required withdrawal can be delayed until April 1st of the year after you turn the qualifying age. That sounds like a helpful gift, doesn't it? A few extra months. But it can quietly backfire. Here quotes why. If you delay that first withdrawal into the following year, you don't escape the second one. Your second required withdrawal is still due by the end of that same year. So you end up taking 2 required withdrawals in a single calendar year, and both count as taxable income on the same tax return. Let me make this real. Picture someone who turns 73 and thinks, I'll wait until next April to take my first withdrawal. No rush. Then next year arrives, and they take that delayed first withdrawal in the spring and their regular second withdrawal by December. Now 2 full distributions land in 1 year's income. What quotes the practical result? Doubling your withdrawals in 1 year can push you into a higher tax bracket. More of your income gets taxed at a higher rate. And it doesn't stop there. More on that consequence in a moment, because it reaches beyond just your tax bracket. Why do so many people misunderstand this? Because the April 1st deadline is described as an option, a convenience. Nobody warns you that using it can stack 2 years of taxable income together. The rule sounds like a favor. In practice, for some people, it's a trap. Who might not be affected? If you take your very first withdrawal in the same year you turn the qualifying age, instead of delaying it, you avoid the pileup entirely. You simply take one withdrawal per year, every year, and spread the income evenly. So what's the action here? Before you decide to delay that first withdrawal, do the math both ways. Ask yourself a direct question. Will taking 2 distributions in 1 year push me into a higher bracket? For many people, taking the first withdrawal on time, in the year they turn the qualifying age, is the smarter, calmer choice, but not always. If your income is unusually low in that first year, delaying could occasionally work in your favor. This is where a quick conversation with a tax professional pays for itself. Here quotes the warning to hold on to. The tax bracket jump is only part of the cost. The withdrawal amount you choose can reach forward and raise a bill you won't even see until 2 years later. That's the point that costs people the most, and it's next. This is the one that matters most because it's the one almost nobody sees coming, and its effects are delayed, which makes it even easier to miss. When you take money out of a traditional IRA or 401k, that withdrawal counts as income. And your income doesn't just affect your taxes, it can also affect 2 other things that hit seniors directly. How much of your Social Security gets taxed, and how much you pay for Medicare. Let quotes start with Medicare because this is the hidden mechanism. Medicare premiums for higher income beneficiaries include an extra charge called IRMAA, the Income-Related Monthly Adjustment Amount. In plain language, it's a surcharge on top of your normal Medicare Part B and Part D premiums if your income rises above certain levels. Here quotes the part that surprises people. IRMAA is based on your income from 2 years earlier. So a large withdrawal you take this year can raise your Medicare premiums 2 years down the road. You take the money out, everything seems fine, and then a surcharge shows up on a bill you'd long forgotten about. Let me give you a clear example. Suppose someone takes an unusually large withdrawal in 1 year, maybe to help a grandchild, or because they delayed and now owe 2 distributions at once. Exactly the trap we just discussed. That single spike in income could push them past an IRMAA threshold. 2 years later, their monthly Medicare premium quietly climbs. They may never connect the higher bill to the withdrawal that caused it. And there's a second layer. That same withdrawal income can make more of your Social Security benefits taxable. A relatively small increase in income can move you from having little of your benefit taxed to having a much larger share taxed. So one large withdrawal can hit you 3 ways at once. Higher income tax, more of your Social Security taxed, and a Medicare surcharge later. Why does it matter more than the other points? Because the first 2 mistakes cost you once. This one can cascade into your taxes, your benefits, and your healthcare costs, sometimes all in the same stretch of time. Who benefits from understanding this? Anyone whose income sits near one of those thresholds. Spreading withdrawals across years, instead of taking one giant lump, can keep you under the lines that trigger these extra costs. Who may not be affected? People whose income stays comfortably low regardless. They may never cross a threshold at all. Here quotes the exact mechanism to remember. It's your total income for the year that matters, not any single account. And the most important limitation, the biggest misunderstanding, is that IRMAA and Social Security taxation aren't punishments for taking your required withdrawals. They're the result of how much income lands in 1 year. You often have more control over the timing than you realize. The correct next step? Before taking a large withdrawal, especially a voluntary one beyond your required minimum, check whether it might push you over an income line that raises your Medicare premiums 2 years later. Here quotes an exception worth knowing, because it changes the whole picture for some people. Roth IRAs work differently. With a Roth account, you already paid taxes on the money going in. Because of that, the original owner is generally not required to take minimum withdrawals during their lifetime. That means no forced distributions, and qualified Roth withdrawals generally don't add to the income that triggers higher Social Security taxes or Medicare surcharges. This is why some people, in the years before required withdrawals begin, look at moving money from a traditional account into a Roth, a strategy often called a Roth conversion. It isn't right for everyone, and a conversion itself creates taxable income in the year you do it. But for the right person, it can reduce these forced withdrawal headaches down the road. If your situation is complex, this is a conversation worth having with a qualified tax professional before you act. Let quotes turn all of this into a clear plan you can actually follow, in the right order. First, confirm your status. Find out whether you've reached the age where required withdrawals begin, which under current law is 73 for most people retiring today. This comes first because everything else depends on knowing whether the rule applies to you yet. Next, gather your numbers. Contact your account provider, your IRA custodian or 401k plan, and ask for your required minimum withdrawal amount for the year. Ask them to confirm the deadline too. Don't guess at this figure. Get it from the source that holds your money. Then, before you take that first withdrawal, compare your options. If you're in your first year, look carefully at whether delaying until the following April would force 2 withdrawals into 1 year. Do the math both ways. This step matters most because the timing decision you make now can raise your taxes for a full year. After that, check the ripple effects. Before taking any large or extra withdrawal, ask whether it could push your income over a line that raises how much of your Social Security is taxed, or triggers a Medicare surcharge 2 years later. It's much easier to space withdrawals out ahead of time than to undo the damage afterward. Finally, confirm everything through official channels. For the current rules, deadlines, and penalty details, rely on the IRS directly or on your plan provider, and consider a licensed tax professional for your personal numbers. Avoid making a major withdrawal decision based only on a tip from a neighbor or a headline. The rules have real exceptions, and your situation is your own. Here, quote, "The most dangerous misunderstanding, and it's worth stating plainly." Many people believe that taking their required withdrawal is what causes higher taxes or higher Medicare costs, so they try to avoid or shrink the withdrawal to dodge those costs. That's backward, and it can get you penalized. You must take at least your required minimum. Skipping it invites that extra penalty we talked about. The real lever isn't whether you withdraw, it's how much lands in 1 year and when. Another distinction to keep straight, a Medicare surcharge is not the same as a cut to your benefits. IRMAA raises what you pay in premiums. It doesn't reduce your Social Security check directly, though it can be deducted from it. And a rule is not the same as a proposal. Withdrawal ages and penalty amounts have changed in recent years through actual law, so what was true a few years ago may not be true now. If you ever get a call or a letter claiming you owe an immediate penalty and demanding payment by gift card or wire transfer, treat it as a scam. Real tax matters are handled through official written channels, not urgent phone threats. When in doubt, verify directly with the IRS or your plan provider before you pay or share anything. So let's bring it home. The costly retirement withdrawal mistake really comes down to 3 things. First, missing your required minimum withdrawal once you reach the qualifying age, which can trigger an extra penalty. Second, the timing trap. Delaying your first withdrawal and accidentally stacking 2 years of income into one, pushing you into a higher bracket. And third, the hidden cost that arrives later, where a large withdrawal quietly raises how much of your Social Security is taxed and can lift your Medicare premiums 2 years down the road. This matters most for people in or near their early 70s with traditional pre-tax accounts. The strongest lesson is that timing is everything. The same withdrawal, spread wisely, can cost far less. The single most important action? Before you take that next withdrawal, get your exact required amount from your provider and think 1 year ahead, not just today. You quote, "We've got more control here than most people realize." If this helped, consider subscribing so you don't miss the next one.